Welcome to the live. We are awaiting the FOMC. I think first we're going to get the summary of economic projections, and then we'll get the Fed's decision. They more likely paused, and I mean, we think we all know they paused. Right after the pause, we will get the actual notes from the meeting. Get Powell present. So we're just waiting on the summary of economic projections that comes along with the rate decision, which everybody expects as a pause. We did get a great number right there. You can see on the screen, PPI. Producer prices came in very low this morning, and the market did gap up early, and now the market did gap up early, and now it's it's consolidating. It's waiting for this meeting to end. So we'll be listening in onto that. What up, user one? How you doing? Good afternoon. And I'll be posting in the chat while Powell does speak, which isn't going to come for another 30 minutes, but I'll be speaking. We're going to go over the macro after this, see how bond yields, the dollars is responding to the rate decision. Right now, the dollar and rates, I think they have peaked. They are cycling lower. That sets up for a Santa Claus rally. I think we're heading to a Santa Claus rally here. And but yeah, we're going to get the summary of economic projections. Well, and I'll be posting in the chat, like I said, some of the, the way that I'm actually interpreting the data, right? Is there anything news? Yes, DXY. How you doing? Yassine, what up? DXY should be going lower from here. It was going up. No, when I say PPI came in good, I'm saying that PPI came in lower. So in context of the stock market, you want lower producer prices. And so lower producer prices is easing inflation. That's easing. Okay, here we go. They just came out.
On average for a Fed official, 80 basis points of rate cuts next year. It had forecast just 50 basis points from a higher level. Of course, they got rid of the expectation for an additional, the forecast for an additional rate hike this year. That's gone. They lowered their inflation outlook for this year to 3.2 from 3.7 for core PCE. That's down by 50 basis points. They hit their 2% inflation target now, maybe a little bit earlier, sort of towards 2025 or the end of 2025. And they see below trend growth of 1.4% next year, a tenth less than the September forecast. Unemployment rate seen at 4.1 next year, about 4/10 higher than the September forecast. And they repeat in the statement that job gains have moderated but remain strong. Now, there's something in the dot plot that I think is worth pointing out. While that median did come down from 5.1 to 4.6, there are 5 Fed officials who are below that 4.6 number who see a full 100 basis points of rate cuts next year, and they're even more dovish into 2025. If you remember, the September forecast, there had been at least one Fed official who was above 6%. That's gone, and the top of the dot plot now for next year is now 5.40. So I would say that the Federal Reserve that today took a step towards the market rather than the market taking a step towards the Fed. I wouldn't say it's an all clear on this, but the Fed definitely backing off plans to hike additionally, or making certain that it plans to hike, and also forecasting more in the way of rate cuts next year for the average Fed official than they had in September. Tyler?
And we are seeing, Steve, about the clearest market reaction we've seen to a meeting in some time, with stocks shooting higher. Dow's up about 150 points right now. And the 10-year yield just sank, at least almost 10 basis points. 13, you can see 4.07 is the intraday. On that note, let's get over to Rick Santelli for some reaction here. Rick?
Yes, 415 is where we were right before the number came out. We're at 406, 407. Obviously, we've been down rather aggressively. The drop 2-year note yields getting down to a 453 level. They were around 467, so about 13, 14 basis point drop. I
Look, the S&P is absolutely spiking. S&P is spiking. They're positive on the economy. They're positive on inflation expectations. Powell will probably come in tight. Hold on, let me make sure you guys can hear me. So Powell will probably come in tight after the way the market reacted. I bet he comes in kind of hawkish. We're not done yet. Well, he's not going to say they're done. He's going to say, hey, if anything comes up, housing is shelter is still elevated, but that's it. That's it. That's the writing on the wall. The market is exploding. He's going to have to come out a little hawkish. He's going to have to come out a little hawkish. What's going to make him a little hawkish? Probably we're not cutting. That's what he's probably going to say more than anything. We're not looking to cut. We are not looking to cut rates anytime soon. And they're going to keep asking him, when would you cut rates? When is the deficit or the pressure on the economy too much? When are you going to cut? That's going to be the main thing that we focus on this meeting. They're just talking about the market exploding, and we'll go back to the summary of economic projections and we'll listen to that again from Rick, not Rick Santali, from the last dude, and because we still got 30 minutes. But the market is absolutely exploding. The dollar is falling. That's it right there. There you go, Yassine. If you're a Forex trader, whatever you are, we have never had a market move this fast just off the economic summary projections. We haven't seen this yet. So that tells you the market's already, the market is pricing in the end of this inflation. I've been saying this for a while. This is the end of the inflation war. That's what that reaction is. The end of the inflation war. The inflation war is over. It's done. We got PPI 0 this morning, 0 producer price inflation. That's going to lead CPI in general. So this inflation war is over. It's just going to come down to when the cuts come in. Nobody believes that there's going to be any more inflation coming back. It's silly. Oil is down. Oil is set to continue to fall, or at least stay even. S&P is spiking. Let's jump over to the S&P, and you guys go ahead and let me know if that volume works. Again, typically it has a little bit of issues, but I appreciate if you guys just say, let me know, hey, the volume is not working. I'll make sure before Powell gets out that we got that in check so we don't miss anything. But come on, we know what he's going to say. Let's take a look at the market right now, because it's absolutely ripping at the moment. It is absolutely ripping. Okay, here we go. S&P is now headed. Oh my gosh, that's a god candle for the S&P right there. That is your god candle. Wow. There goes the shorts on Tesla. We'll see how crypto responds. Here's the Qs. The Qs, I think all-time highs for the Qs is 408. Still has a way to go, but I mean, and this could just be, shorts covering. Also, it's probably more than likely a lot of shorts are covering off the data, because there's a lot of algorithms who are going to be triggered by certain specific terminology that come into the summary of economic projections. And what I'm going to do is try to see any highlights in there, because I want to hear him talk again, but we're going to look for some highlights. We're going to look for some highlights on that. But yeah, we're ripping. I mean, that's it. We are ripping. Okay, let me keep that. We're watching the market here. And if you want me to look at, okay, there we go. So yeah, the shorts did squeeze. We might come all the way back down, but what it does tell you is if Powell doesn't diverge too much, which he's not, he's going to support the summary of economic projections. So what this tells you is, as he supports it during the meeting, they're going to ask him a lot of questions. We should retrace back down to VWAP. My guess is we come back into VWAP. That was a short squeeze. We come back into VWAP, and then as he talks, we're probably going to, grind down, grind up, grind down, and we probably come back up, right? We'll see, because this is it. This is pretty much the last big data you have. That's it. We're done with CPI. We're done with inflation. That's over. The rate decision is next. They paused. They're done. We're at the end of the cycle. And the big indicator here for most people, to make it very simple, the dollar is getting crushed. Okay, what does that mean? The market is anticipating more monetary stimulus at the end of the tightening cycle. That's it. This is the end of the tightening cycle, right? So now you're going to get, let's zoom out a little bit. Now you're going to get the dollar, okay, pretty much start to trend down. Does it just collapse? Nah, probably not. But the dollar, that's it. We talked about this yesterday. This was resistance for the US dollar. The reason I say that, because this is the cost of trade. If the cost of trade comes down, this is going to impact all S&P companies who are multinationals, right? They have companies in China, India, whatever it is, including like Tesla, Apple, right? Amazon, big companies. And that actually increases their margins, right? As the dollar falls, this increases margins for the big tech multinational companies. That's why the Qs are popping. And also at the same time, the dollar is very correlated to a bull market, right? As the dollar falls or moves sideways, you just need a sideways dollar or possibly a dollar that just goes straight, down or sideways. That's bullish. If it just collapses, very bullish. And that's the easing, right? That is easing there. Let me check my double check my audio. You guys let me know if the audio is fine. Just want to make sure that everything's coming through on the feed. Sometimes there's a little bit of issues. Echo cancellation. I think we're good. Yeah, I think we're good. All right. So we have the dollar, right? Coming down. Now the next major macro force here is natural gas. No, I'm just playing. Natural gas is plummeting also. So energy prices are down. Copper prices are not really moving anywhere. Wheat prices are down. This is food inflation going forward, right? And in oil, right? Oil is probably headed for 60. It is oversold, but oil is probably headed down here. Energy prices are low. That's driving inflation for the most part. So just keep in mind, if we just move sideways on oil, right, in the price of energy, very bullish for the market. Producer prices are already lower, so input costs are lower. That means S&P companies can continue to use AI to boost productivity, right? They can see lower prices on the top line. And when you go to the bottom line should increase. And, the cost of capital is the biggest force here. We just made a new low. This is the 10-year bond yield, the real rate of interest for the market. Okay, we got some more. I think we have some more data here. Let's go to Steve Leisman. He should be reporting on that data. Okay, I'm going to go back to that. So the cost of capital is down, very bullish for the market. Now, Powell might speak against this because remember, Powell says, hey, if things are too hot, I want rates to be higher. But we know things are not hot. Inflation is coming down. The consumer is set to slow January, February, March because seasonal spending is over, right? Seasonal jobs, they're pretty much done. You're not going to see any more inflation. Oil's down. And as this trickles back down, this has been the tightening mechanism for the market, right? Higher rates. They've been exploding like almost like a risk asset. They've been moving higher. So as they come down, this is going to fuel that bull market much faster, fuel the bull market. It also eases a lot of people have to refinance, right? It eases those risks, those credit risks. And we do see the VIX almost making a new low. We'll see. Powell comes out, will probably reverse a little bit, but I still think this is it. I mean, that kind of put the nail in the coffin. And Powell, they're just going to ask him, when are you going to cut? That's what we're looking at here. When are you going to cut is what they're asking him, is what they're more likely going to ask. Probably 1,000 questions on that. We'll see how he caresses this because we're probably going to get a bull market. And no, higher asset prices does not mean inflation. It just means people are more confident. Plus, we're getting productivity. So let's jump back into that daily chart really quick to see how that short squeeze is faring. Okay, big short squeeze. Wow, big short squeeze. How far are we actually from? Let's see how far we are from the last pivot. So we're above that last pivot over here on the S&P. Well, SPY. We can jump to SPX, and we are now from all-time highs. Right, we are now 2 3/4 from all-time highs. Okay, the S&P is now 2 3/4 from all-time highs. There's really not a whole lot ahead of us other than positioning. We are a little overextended, but this can stay for a while because the biggest fears in the market just ended. The Fed cycle is done, inflation is done. Those are the big fears. Now it's recession, but we all know that growth is still steady. Jobs are still there. Employment is the backbone to the economy. All right, let's turn to Steve Leisman and hear a little more on what those summary or what else he has to say about the summary of economic projections. Let me make sure that this is okay. There we go. Okay, the audio should be working. Let me know if it's not working.
Cable television ESP right there, because that's exactly what I was going to talk about. That here's what happened. The Fed moved to the market, and the market moved away and further from the Fed. I was actually looking at the probabilities for March, which had been, around 40% probability for a cut. It's now 62%. For May, it's 90 basis points. And I hate to do this live on TV, but yeah, there's the January 2025 contract, which sees 4.05. So there's about 135 basis points of rate cuts built into the futures guide. That's the problem. And we may be back to where we were again where, okay, the Fed is taking a move toward the market's taking a move. The Fed's taking a move towards the market, and now the Fed may have to rein expectations back in. Again, we're going to have to watch the data. The inflation data, John is right, is what's going to determine what happens here. There are good reasons to expect it to come in, but the data actually needs to perform for the Fed to do what the market wants it to do.
David Kelly, your thoughts?
All right, so yeah, let's take a look at that. We have 2024, we're looking at, oh, this is the unemployment forecast, 4.1%. I really doubt we get here. Actually, we could see this 4.1%, and that's not bad. A lot of people say that's terrible, but it's not, because here's the thing: the gig economy, as we've been talking about, the productivity gig economy. So people are doing Uber and Lyft. They don't show up on the unemployment report. They're not going to show up, right? They're just not going to show up. So what that tells us is, even if the unemployment rate's at 4.1, historically, that's pretty even. That's pretty fair. And I just don't see it happening with all the fiscal policy coming in. We are in a pre-election year also. That's the biggest factor. One of the biggest factors, we're in a pre-election year. So there's going to be more jobs printing. There's going to be more promises if anything slows here. I actually want to go back to here when he first talked about these economic projections. Again, we have 30 minutes, right? No rush. We still have, well, not 30. We have about 15 minutes before he comes out. So this is why the S&P is popping. Breaking news.
Steve Leisman.
Federal Reserve leaving interest rates unchanged at 5.25% to 5.5%, a unanimous decision in the December meeting.
So unanimous decision, that's a key factor right there. That's the first time we've got a pure unanimous decision. No more hikes.
The Fed says growth has slowed from the strong third quarter pace, saying inflation has eased over the past year, but remains elevated. It is the first time they said anything positive about inflation.
So that's new. The inflation has eased and growth for the fourth quarter. So what they're saying is fourth quarter growth is slowing. Therefore, there is no chance that inflation comes back. There's no chance that they are going to hike anymore. It's done because growth is slowing. Therefore, inflation should continue and follow that along with it.
For a very long time in the statement, and they backed off somewhat their bias to hike, saying it was now determining the extent of any additional policy firming, inserting the word any into the statement for the first time. They lowered their 2020
they will not hike again. That's it. This is it. Well, we'll see how Powell reacts, right? Because that's what it comes down to. We'll see what he says. But is he gonna try to counter that nobody's, they're done hiking? Is he gonna counter that? I don't think he can really counter that. They've said it in their economic projections, telegraphing to the market. This is it. Now here comes the money market funds. That's what you got to keep ahead of. These money market fund cash flows at all-time highs are going to start flowing back into equities.
24 Fed funds outlook to 4.6% from 5.1%, so half a point down, forecasting on average for a Fed official 80 basis points of rate cuts next year. It had forecast just 50 basis points from a higher level.
Okay, so now they're forecasting, they're pulling the rate cuts. They're basically forecasting that the cuts are coming sooner than they said before, right? Cuts are coming sooner. Rate cuts are coming sooner. That's why the market is spiking, because they have just shifted gears to, hey, inflation is making more progress than we expected in the last meeting. Now we can cut, not because of a recession. We can cut because pressure is coming down. Remember, they will cut before 2%. Powell's made that clear. They're not going to cut and wait. They're not going to wait till 2% because it's a momentum indicator. It's falling, it's falling, it's falling. They're going to cut right before 2%. And that means we're getting closer to cuts, right? Not because of negative. We're getting closer to cuts because the improvement on the backdrop of inflation.
Of course, they got rid of the expectation for the forecast for an additional rate hike this year. That's gone. They lowered their inflation outlook for this year to 3.2 from 3.7 for core PCE. That's down by 50 basis points. They hit their 2% inflation target now, maybe a little bit earlier, sort of towards 2025 or the end of 2025. And they see below trend growth of 1.4% next year, a tenth less than the September.
So look, they're seeing slower growth. So here comes the panic from all the recessionists, right? The perma bears. Well, the economy is going to collapse. Keep in mind this, guys. If the economy does slow down to some degree, because they are forecasting slower growth, a little below trend, well, what do you have? You have now a big cushion. Rates are so high, you have a big cushion, so they can incrementally cut to increase that growth to some degree. They can also stop draining their Fed balance sheet. They can start cutting it break even, right? That's going to help growth. Capital markets, more than anything, actually, And the big factor here, fiscal policy. Now that inflation's done, Biden will unleash more stimulus, right? Maybe not direct checks because that might be too much, but he's going to start increasing, right? Okay, here goes another bill. Let's try to get this growth going. We have announced this. So expect that to come below growth trend. Growth below trend will not continue. We're going to have stronger growth than people expect because of AI, because of productivity is picking up, because immigration's coming in and capping those wages because more immigrants are willing to work for less. So productivity is picking up. AI is contributing to that. And the ISM manufacturing survey, which leads growth, is starting to rebound, right? That is the big factor here. So this is very bullish.
Forecast. Unemployment rate seen at 4.1 next year, about 0.4 higher than the September forecast. And then they repeat in the statement that job gains have moderated but remain strong. Now, there's something in the dot plot that I think is worth pointing out. While that median did come down from 5.1 to 4.6, there are 5 Fed officials who are below that 4.6 number who see a full 100 basis points of rate cuts next year, and they're even more dovish into 2025. If you remember the September forecast, there had been at least one Fed official who was above 6%. That's gone. And that's
okay. So there were, in the last meeting, there were a couple of Fed officials who were saying we need to bring rates to 6%. It was only a couple of them. They're gone. That's done. The dot plot has now shifted towards a bias towards cutting rates more so. And I know we've just said this, we're reiterating, but and I don't have the charts up, but for the most part, they're basically saying, okay, there's no chance that we're gonna hike at all. There's 11, I think there's 11 officials. All 11 officials agree that this is over, and none of them see any higher rates. And wow, the S&P is still pumping. So we probably got a short squeeze, plus traders jumping in, plus positioning is starting to come back into the market. So we're getting a huge rebound here. The dollar's still falling, oil is still flat, and rates are the 10-year rate is falling. So Powell, this is going to be a very interesting meeting because Powell might have to be a little. It's hard for him to be hawkish after this, after the summary of economic projections. So let's see what he says.
Top of the dot plot now for next year is now 540. So I would say that the Federal Reserve that today took a step towards the market rather than the market taking a step towards the Fed. I wouldn't say it's an all clear on this, but the Fed definitely backing off plans.
Okay, yeah, that's it. That was pretty much the summary of economic projections. The inflation fight is over. Now we just have a couple comments on it. But let's turn to the market. Let's turn to the actual charts to see how market psychology is playing into this move. And stay tuned. We got Powell in about nine minutes. So right now, S&P, this is a 5-minute chart. So the S&P is now up almost 1%. Well, no, 0.75%. That's a huge move for S&P. See, from the lows, this was previous day close. So we came right off of yesterday's close, and we are up, 0.75% from yesterday's close. So I think what this is money market fund liquidities coming back into the market incrementally. It's going to want to see a pullback. It'll be healthy if we do get a pullback, but you could just think of it this way. The dollar is falling because dollars are now reallocating back into equities. And you also have a bid on the bond market. So you're getting, and I've said this before, we're going to get a double move here, which is bonds bid up and stocks bid up. But if growth does start to outpace their projections, then bonds probably slow down a little down the road, because why own protection against growth when growth starts to ramp back up, right? We can go take a look at a couple of stocks here. Looks like Tesla's starting to recover here from the lows. And let's look at a couple stocks here, or we can even look at sectors. We can look at sectors before Powell comes out. This is the semiconductor sector, right? The ETF SMH moving up sharply. Okay, this is materials. I don't think nobody really cares. This is communication sector. This one has a huge bid too. There's a lot of infrastructure, fiscal stimulus coming into communications for technology. Energy is kind of mute. See, energy boosted because it's part of the S&P, but energy is not up as much because, hey, energy prices have fallen. Those margins are no longer going higher. XLF financials really need to recover. A lot of people say this is key for the rally to see financials start to rebound. Industrials, this should have a nice bid on the market because industrials are going to be where a lot of the investment goes into to produce. And if you're wondering who are those industrial stocks, I kind of have a list here of my favorite industrial stocks that I'm looking at. Deere Company, right? They're going to get a lot of growth as we grow the economy, as infrastructure comes back, as we get more infrastructure spend into the economy, right? Caterpillar, really like Caterpillar. Wow, big move from Caterpillar. FedEx, UPS, more logistics. Those probably have peaked because we're at the end of seasonal spending, right? So their business model is going to slow into January, February. Who else we got? Yeah, so that's industrials. Those are my favorite industrial stocks. If we look at tech, let's just go ahead and take a look at big tech and small caps. Wow, small caps are booming, probably headed for new highs now. This is market breadth starting to turn up. Let's take a look at the Dow, make sure we don't miss it. We got 5 minutes until Powell comes out. We are awaiting Powell. He's not out yet. Don't worry, we'll switch over there. All right, so yeah, the Dow's up, ARK is up. I mean, everyone's up, right? Who are we kidding? We're all up. I'm just looking for a displacement. Amazon still not at the highs. Google, wow, Google sank sharply. Meta, Microsoft, Netflix. Ooh, Netflix is bidding up. Wow, Netflix is bidding up, lower rates. That's going to increase probably subscriptions for Netflix. Yeah, DXY dumped fast, very fast, Yasin. That's it for DXY. AMD, AMD is probably headed for new highs. Right. Well, let's go ahead and flip back to the macro, because this is what's going to fuel this bull market going forward, which is, the dollar continuing to sink. So let's go ahead and take a look at where the next resistance is for the dollar. I'm sorry, support. Next support for the dollar. Very fast drop here. Wow, that was a big move. I didn't anticipate that big of a move. So let's just take a look here at the dollar. So we have some support here. Yeah, we got a clear support here for the dollar, but let's just take that last move. Actually, let's do it on the weekly. There you go. So this is the support for the dollar right now. We're starting to violate that trend. Let's go into the daily chart really quick. All right, so yeah, there we are for the dollar. If the dollar continues to fall off of Powell's speech, that's it, man. That's it. This is a big surprise to a lot of investors. We couldn't get past this 104 level, and really the big level here to restart risk on, like complete risk on. I don't know how quick we get here, is below this really 101. Let's call it, well, it's really 199 level. Okay, that's it right there. So that's our last support before the dollar turns into a secular driver or a huge tailwind. So under this level, and I don't expect it to stay here, but under this level, the dollar really converts into a tailwind for risk assets, crypto, and equities in general. And what that also is happening is people are exiting their dollars, or they're converting their dollars into assets, right? They're converting their dollars into assets. Let's take a look at rates here. Next stop for rates. Looks like a little head and shoulders. Forget the trend. The next stop for rates might be back where the banking crisis bottomed, right? This was the March 2023 banking crisis bottom. And we could be headed here. This is huge. This is fuel for risk assets in general. All right. Let's go ahead and switch over. I think we're no, Powell's not up yet. We got like 3 minutes. Does PPI lead CPI? Yes. Yeah, so rates are headed for new lows. See where 30 years at. 30 years headed for new lows. This is going to help the housing market also. Housing market starts to get a bid. Move index. This is bond volatility. That's down. The VIX. We'll see if the VIX makes new lows after the meeting. And I think really the dollar is the most important chart here for the bulls, right? The dollar and rates. Those are your two important charts. Oil obviously has been falling already. All right, let's just go ahead and switch over. Let's go ahead and switch over. I think Powell's almost ready to come out.
I think he's theoretically on board with the idea of cutting rates as inflation falls, even if the economy hasn't slowed down.
All right, so when he comes out, I'll turn it on. I'm also going to switch. Let's switch down here so we can see. Let me see which side's better. This side or this side? Right side, left side. We'll stay left side. We'll stay on this side. It's you can see more of the screen. So yes, PPI does lead CPI. It does lead CPI for sure. We're almost ready. I'll just be posting in the chat. Ooh, wow, what a reversal. What a reversal. Okay, S&P is now pulling back a little bit.
Why,
How's it
why
sound?
does Joe Biden seem to get no credit and only blame for where inflation is and for the fact that inflation has come down? Why does the administration seem to get no credit for low unemployment and really relatively strong growth? Why?
Well, I think part of it may be, the clarity of messaging, to be honest.
Mhm.
I wonder if, if Ronald Reagan or Barack Obama were making these had the same economy, whether it might be a little clearer. But, I don't really want to get into the political judgment here, because I think the other thing is I think people are exhausted after the pandemic. I think people don't think about inflation; they think about high prices, and they still regret the price of a lot of things they bought a few years ago.
Well, that's
think
exactly
high.
right. I mean, it's not as though the price of groceries has come down dramatically. Just the rate of growth in those prices has slowed, which I suppose is a good sign. But it's not as though my $16 bottle of Persil detergent has come back down to $12 a bottle.
Well, that's right. But when you look at financial markets, what really matters for the pricing of financial assets is future inflation, not current prices.
Let me interrupt you for Chair Powell.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast. So many people mentioned what their rate forecast was. There was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. Preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious, if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy. And I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down they basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor. And it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter. And as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward. But that's another assessment that we're going to make very carefully. So as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth. And, I'm just focused on what's the right thing for us to do. And my colleagues are focused on that, too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So, it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient? So
we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, if we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Good, Neil. Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing the shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now real wages are now positive, so that wages are now moving up more than inflation as inflation comes down, and so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria?
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
That's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. We're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, this, but allow me to say it again. We don't debate or discuss what the right, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina. Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, a little maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
You see, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this, difficult, uncertain, really unprecedented environment. Someone once said that the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are of course stickier. So when looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, you know, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and you know, I think you'll see a reasonable estimate of the time lags and things like that it would take.
3% would be reasonable.
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the US economy?
I think this, you know, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions to supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there was something different about the US economy.
Yeah, so it's not that, it may or may not be about the US economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand without question and unusual supply side restrictions, both on the goods side, but also on the labor side, because we had a participation shock. So this is just very unusual. And, you know, we had the view, my colleagues and I broadly had the view that we could get a lot of, you know, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, you know, something like that has happened. It happened so far. The question is, you know, once that part of it runs out, and we think it has a ways to run, we definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to, you know, to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down, the labor market keeps getting back into balance, and you know, it's so far so good. Although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we're going to make it to the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or as a result or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out. And at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
And with that, welcome to Closing Bell. I'm Scott Wapner here at the New York Stock Exchange. Fed Chair Powell, as you see, wrapping up his final meeting and news conference of the year, a third straight pause, and what can really only be called dovish language in both the statement and from the Fed chair himself. As a result of that, stocks are rallying. I want you to take a look here. The Dow, a new record high, was trading above 37,000 for the first time ever. Stocks are higher and sharply so across the board. Yields, they're going in the opposite direction. They are falling, and they are falling sharply. Look at the 10-year note yield, 4.04. Just an extraordinary a bit of events there in Washington. The Fed chair saying they're proceeding carefully. They're seeing what they've wanted to see in terms of inflation coming down. He mentioned their own estimates of PCE continuing to move closer towards target. Stocks up a little more on that. He said the Fed is, quote, likely at or near the peak rate for this cycle. Stocks up a little more on that. Bob Pisani calling what happened today about as Goldilocks as it gets. Our own Steve Leisman, who's going to join us momentarily, suggesting, quote, the Fed took a step towards the market rather than the other way around. Joining me now is Double Line Capital's Jeffrey Gunlock. He's with us exclusively, as he always is once the Fed chair finishes. Jeffrey, welcome back for our final visit of the year. I'm glad you're with us today.
Yeah, we made it all the way to December, Judge. Interesting times.
Yeah, that's for certain. I mentioned what Pisani and Leisman have called it. What would you call today?
Well, it's pretty dovish. I mean, the word of the day is any. Last meeting, the word was careful. He said that multiple times last meeting. Market likes that because it respected the fact the curve's inverted and economy slowing down. But that any word didn't have to be inserted. And it strongly suggests that the Fed inserted that because they believe, I think, that they're done. And not only are they done, what a lot of people don't realize is the Fed has been on hold for 4 of the last 5 meetings. So it's a trend. And we talked last meeting, November 1st, that we had started a bond rally that day. And what a rally it's turned into. It's turned into quite a good 6 weeks with the 10-year Treasury yield down 100 basis points and the long bond, up in the double digits. So we had a November to remember, one of my clients said in a meeting I did with him yesterday, with one of the best months ever for the investment grade bond market, up over 4.5% in the month of November alone. That hasn't happened since the 80s, which is really something, because last time it happened, you were starting with yields up at 10%-ish. And here you were starting with yields at 5-ish, so half the yield. So you needed an even bigger basis point move in rates. So I thought the most interesting thing in the press conference came near the end, where, if I heard it right, I think Jay Powell said that he wants to cut rates before we get to 2, if I heard him right. And because he's respecting the momentum that inflation can have, just like I criticized him 2 years ago for going too slowly, and inflation overshot by 500 basis points above where they thought it was going to 4% or so. It peaked out in the CPI at 9, and now it's coming down just as fast. And I heard a lot of people before the announcement were talking about, you can take 3-month PCE, you can take it, look at core this and that, 1-month data and everything. There's ways to get to 2% sort of numbers. And I'll just add one that I didn't hear today. That's core CPI ex shelter, which is at 2%. And the reason I bring that up is shelter is a bad construct. It's owner's equivalent rent, and it lags. And it appears to our research that owner's equivalent rent is going to come down by at least 400 basis points over the course of 2024. And since that's about 30% of CPI, kind of there you go. So our CPI model suggests that we're only going to get 1 more month of a 3-handle CPI year over year, and that it's quite possible at this point that the headline CPI could be 2.4 in June. And if that's the case, I think the Fed cuts rates, because I heard Jay Powell, I think, say that, we can't wait until inflation's at 2, because he respects the momentum on the downside, because he learned a little bit of a lesson about the momentum on the upside.
He said, he said they're aware of the risks of waiting too long to cut rates. Jeffrey, he mentioned on numerous occasions today the possibility of cutting for the so-called right reasons. If the economy is just normalizing, you got from the outlook today, the so-called dot plot, 80 points of cuts next year. As I mentioned, how Leisman characterized this, the Fed moving closer to the market rather than the other way around. Would you agree with that? Do you see cuts, and several of them next year, for the right reasons?
I don't really see them for the so-called right reason. I think that's what's baked into the dot plot, and a little bit less so, but somewhat to the shape of the yield curve, that they're just going to cut by 0.75 of a percentage point or so, says the Fed. I mean, I think that's pretty unlikely. I think that if they cut rates that much, they'll have to cut them more than that. So I believe that we're going to see the yield curve de-inverting in the first part of next year. I think we're still going to have bonds rallying. We've broken down below the trend line on the 10-year Treasury yield that goes back a couple of years, and there's a lot of room below it. I would guess that we will see the 10-year Treasury yield in the low 3s sometime next year. And that would be consistent, in my view, only with the Fed cutting more like, 200.
So this is the bond king, and he has no other incentive but to, because the race right now is now bonds versus stocks, right? What's a better investment? What's going to move the most? I think he's going to call for recession. And he's basically saying that, yes, the Fed will cut rates. It'll help equities at first. I haven't even heard him talk yet, but watch this. Equities will move along with bonds, but then equities will not be a better investment because the Fed cannot save the economy from falling over, that it will fall faster than everyone is expecting, and that stocks will struggle, but bonds will continue to move higher. So he's going to try to make the case that bonds are a better investment than equities. And the question is, he is not going to address, somebody needs to ask him, okay, what about the fiscal policy? What about the chances of the election cycle and Biden printing more stimulus? What about the Inflation Reduction Act? What about the CHIPS Act? What about the infrastructure bill, right? What about those coming into the economy? Also, what about productivity starting to climb? What about supply chains fixed? So he's going to try to make the case that growth collapses. And maybe I'm off a little bit, but I think he's just trying to make the case that bonds are a better investment. I would disagree with them simply because I think the economy is much stronger than people, and this is not political, but it's going to be much stronger. And if the Fed cuts rates, well, even if the economy still lags, stocks are going to go ballistic, especially tech stocks that still have a better margin. So yeah, maybe IWM struggles. Obviously, small caps, they haven't turned a profit yet, right? They're more guesses into the future. But I happen to think growth actually starts to go higher because of this productivity is picking up, because the ISM, number one, the ISM manufacturing survey is starting to pick up. We're leaving the recession, right? So he thinks we're late cycle. I think that we're actually early cycle, that the recession has already passed and we're still in it. We're in the late innings of the recession and we're actually early cycle expansion, a reacceleration based off the ISM. Watch them talk up the bond market.
100 basis points or even more next year. So I think we're looking for a recession next year. We've been talking about this. The market seems to be picking up on that. And we're starting to see the good part of the pivot from the Fed, which is relaxation of financial conditions. And that leads to, for the first moment, risk assets doing well. And of course, they've done very, very well since the last Fed meeting. And I suspect it's going to not be a trend change before year end. But I believe that I noticed the action of the stock market was interesting today, because as the 10-year Treasury got all the way down to 4.0% and it couldn't break through down to a 3 handle, I noticed that the stock market started to lose momentum. And then when it backed up on the 10-year to where it is now, it's just a few basis points. But there's something about if you break below 4 on the 10-year that I think it almost sounds like a fire alarm going off relative to the economy. And I think we might start to see the correlation of strong bonds and strong equities start to break down. When it comes to fixed income strategy.
See, I told you, what did I tell you? He is talking his book, which is cool. Yeah, talk your book. But he is the bond king. So he's going to say, hey, everybody, at first, stocks will rise with bonds, but eventually things will weaken too much. The recession is going to be worse. And then he's saying basically that falling rates at some point will no longer help stocks because it's going to signal weakness of growth. And did we not call it or what? Did we not call it or what? This is Jeffrey Gundlach. Of course, he's speaking his book. Of course, I'm speaking my book. We'll see who's right. He's not addressing fiscal policy coming in. He's not addressing the fact that the ISM surveys are moving up, that they're actually bottoming. Let's say if he mentions the ISM, because I respect the guy. I think bonds do rise, but not as fast as the Qs, not as fast as NASDAQ, not as fast as Apple, Amazon, Google, Facebook, Tesla. And so there's other names out there too, a lot of IWM small caps. But in whole, he's talking his book, and let's hear what he has to say. I mean, he does have, I agree with him on 90%, except for the fact that the economy is just going to collapse. Inflation's coming down faster than he even thought. And the real disconnect here is that he just thinks bonds will outperform stocks simply because stocks will lose their growth. Well, we already saw the projections for profit margins to rise going forward.
Strategy. I outlined that I didn't like T-bill and chill. That's what we talked about the last meeting. I said there's nothing wrong with a 556-month bill except the fact that you only get it for 6 months. You wanted to be a little bit further out the curve, say 3 to 5 years in credit, and marry that with long-term treasuries. And all of that has worked. And I think that it's likely to continue to work in the new year. We have been advocating strongly for this type of a strategy, and we've gotten a lot of interest from large institutional clients. And one of them was about to pull the trigger maybe 2 weeks ago, called us today and said, gee, did we miss it? Which is really interesting, because I think that all this money that's in money market funds and that might be over allocated to other assets than bonds and institutions, I think the logic that people have that money market bloat is going to go into the stock market is wrong. I think it's unlikely for investors to go from risk-free 6-month T-bills to the Magnificent Seven at massive PEs and all-time highs on the Dow Jones Industrials. I think they're much more likely to go from their mountain of cash in T-bills into bonds. And so I think that the strategies that I've outlined in the past couple of times we met, which have been this mix of credit in the middle of the capital structure and long-term treasuries, I think you stay with it for now. I've been thinking about that movie Braveheart, where they're about to attack and the Mel Gibson character is saying, hold, 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 hold. You know, they want to fire or do whatever their assault is, but they have to wait for the right moment. I think you have to wait for the right moment to alter this bond strategy. And that
okay.
right moment will be when the recession comes.
I mean, maybe maybe some of the money in money markets is split. Maybe some goes into bonds for the very reasons you suggest. Maybe some goes into stocks because they see the possibility of a powerful new bull market developing. I'm going to go.
Massive PEs. I mean, bro, we are starting to reaccelerate. So as long as earnings reaccelerate going forward, there's not going to be first of all, we're not even at massive PEs. The S&P, I think, forward PE is literally below the 5-year average and above the 10-year average. We're not seeing massive PEs. The only thing he's pointing to is the Mag 7. But if you X Mag 7, you know, earnings are really low. The PEs are not very high. They're not exceedingly high. Plus, technology always has higher PEs because they produce higher growth. So he's actually not like, duh. If rates fall, then that actually increases the earnings expectations for the tech stocks into the future because 10-year rates are looking 10 years ahead. So I think he's wrong here. And I don't know if anybody's going to push back on him, but his whole bet is that the economy falls into a deep recession. So we'll keep our eye on that. Services are still positive. And if there's any chance that we do fall into a deeper recession than expected, it's going to be Q1 to Q2. It's going to be somewhere between February, March, April, May, probably March, April, May, June, right? That somewhere in there, February, March, April, May, that's where there's going to be a recession if there is one, because seasonal spending is over, but it's the election cycle. Look out for more stimulus. Also, the gig economy. He's not counting on the gig economy. People who work for Uber, OnlyFans, always say this, YouTubers, right? Freelance work, social media managers, all this new type of technical using AI, all these different jobs they're not really jobs on payrolls. They're actually just gig work and they're coming from software. So he's not counting that. And if the spending continues, plus the money market fund, the wealthiest people are making 5% on their cash. They're going to keep spending. Apple has over 60 billion, maybe $100 billion of cash. They're going to keep spending. So yes, there's going to be some slowdown in some certain areas, but there's also going to be a speed up in other areas. And the Fed did just make it clear they're not going to stop the balance sheet, which is very interesting. They're not going to stop draining money from the money supply. They're more likely to cut rates, which I thought was the opposite. So it looks like they're more likely to actually cut rates before they kick the money supply. But that's really hard to believe. That's really hard to believe because at some point, the U.S. Treasury, somebody's going to have to buy that debt. And I think that's where Jeffrey Gundlach's bull case for bonds comes in, which is nobody's going to be able to buy the U.S. debt. Therefore, rates go right back up and stocks cannot handle that. He just said that. He's like, yeah, well, guess what? Stocks do go up when rates fall. But if rates do lift at all, if rates lift a little too much, then stocks can't handle it. They get a little shaky. But I happen to not believe that. I think as long as this productivity theme continues, which is growth is growing, we're getting growth in the economy in certain segments from artificial intelligence. What does that mean for AI LLMs? It basically means that you're getting more growth at a lower cost. So profit margins continue to climb for certain companies. He's saying he's saying big tech and the mega caps aren't going to be able to handle this. But if they keep growing, you see all this cost cutting. I don't know if you guys are seeing, there's a lot of layoffs going on. Those layoffs are going, that spending, that CapEx that's going out of employment is going straight to margins. So revenues actually, I don't want to say revenues, but margins should continue to climb, even if you get flat revenues. And then, the CHIPS Act is going to keep pouring in. That's more revenue for chip companies, for anything around technology. And you're just going to get more fiscal stimulus. So yeah, I think Jeff Gundlach is wrong. I just want to, respond to what he's saying.
Hang on just for a second, Jeffrey. Steve Leisman's just stepped out of the room, and I do want to go to him because, Steve, this was extraordinary on a number of levels, I think. Number one, the Fed chair in his news conference did nothing to walk anything back from the statement. He did nothing to hawk it up, so to speak. And I know he sounded like it would be premature, and he said as much, premature to declare victory. There was no jumpsuit. There was no aircraft carrier, but he doesn't seem like he's that far away either from doing just that.
Yeah, I think this was a pretty big day, Scott. I think that the Fed pivoted today. I think it went from having this bias to hike to being in neutral with a forecast to cut rates. And I think that's a pretty big deal. And he acknowledged in response to my question that, yeah, they sat around the table today and yesterday, and they talked about.
Hey, what do you guys think in the comments? Do you think bonds outperform stocks? Put a B for bonds or put an S for stocks. No, I am not live on Instagram.
Rate cuts. Here's a quote from the press conference.
The other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Scott, I thought the chair might have tried to hold back the water on the dam one more meeting. I guess the data yesterday and today, especially the PPI and what it says, he mentioned this specifically. We talked about it on your show at noon today. What the data today says what's going to happen to the PCE numbers next week made it kind of untenable for him to hold back and to maintain a position that was too hawkish. And just real quick, we have been talking about this number that Jeff was talking about, this CPI ex shelter, which has been below 2% for several months now. There's that number right there, and you can see it. It's down below 2. And then, okay, so it's not fair to take shelter out. The reason you take shelter out is because the shelter in component they use there is lagged about 3/4, Scott, from some of the other market-based indicators that are out there. And if you fold those in, you really don't have a problem. It may be that the Fed is already there. And the concern was that the Fed would keep rates high and depress the economy for too long based on bad data.
Steve, I appreciate it. Quite a day that I know we're going to be talking about many more times in the days ahead. That's our senior economics reporter, Steve Leisman, just out of the news conference with the chair. Back to Jeffrey Gundlach, who's with us exclusively, of course, from.
Yeah, so here's the growth I'm talking about. Productivity gains, right? We're seeing the highest. This is from the Bureau of Labor Statistics, the highest level of 10 in productivity in 10 years. That actually was revised to 5.2 right there where it says today. That is today. That is third quarter. Going into fourth quarter, we're seeing the highest productivity levels, which is growth without inflation, absorbing inflation. So how is it that we're heading to this deep dark recession when productivity is actually accelerating? You can see on the chart there, we're at the highest levels ex pandemic, because obviously the pandemic was massive stimulus. So we're at the highest levels ex financial crisis, which was 2010. It's not on this chart, but we're basically at the highest growth outside of massive stimulus, which was 2008 after the crisis and 2020 after the crisis. So we're moving outside of the crisis, and we still have we have cuts actually to come in. We have the Fed balance sheet with the big cushion, meaning that can actually stimulate. We have more fiscal policy, and we have productivity rising. So that's growth starting to come in because these supply chains, like you said, there's no pressure on the supply chains. And although people, start to say, oh, demand is going to, and how is inflation going up? People are spending. That's because the supply side restrictions are gone. So it absorbs inflation, period. Now, here's why the market is shooting up. This is how much leverage is in the market on average, that line across 0.3. That's kind of the average leverage. There's a lot of cash on the sideline. So the market is, we might be at all-time highs, but a lot of cash is going to leverage in. This is where I differ from Jeffrey Gundlach. Okay. He says, well, that leverage is going to come into bonds. I really doubt it. I think that leverage comes into stocks, maybe both, right? The bonds are a good bet, but you have to bet there's a small recession where stocks are secular. They're going to keep growing. You have secular things like blockchain, AI, energy storage, electric vehicles, right? Genomics. We just got CRISPR, not CRISPR. Yeah, we got CRISPR regulation. The FDA is now approving CRISPR editing technology. So I think, again, this cash, this margin that has been suppressed following the recession, following the drop, is now coming back. And I think that comes back mostly into equities.
Double line. So, Jeffrey, how come you're not willing to go as far as to say, you know what, I no longer think that we're going to have a recession. I'm wrong at this point. The economy is better than I ever thought it would be at this point. Inflation's come down much quicker than I ever thought it would be at this point. And you know what? Maybe the Fed's going to pull this off after all.
Well, I don't think inflation's come down faster than I expected to. It's really followed the trajectory pretty closely, and it's going to continue to fall further. I just think that a lot of the way the market works through cycles, I thought is so often the case. Brian Kelly, I think his name is on that segment before
David,
the announcement is
I know
read.
you're talking about David Kelly, and he was talking
David
about
Kelly, yeah.
a pivot that he saw, that this was a pivot today.
Yeah, not just that, though. He points out that when you first start raising rates from low levels, it doesn't have a real market damage. But then similarly, when you start cutting rates from high levels, you start to affect the economy in a negative way, somewhat counterintuitively, because people might wait for lower interest rates if they think they're coming to do things, and it can accelerate the deterioration of the economy. And also, the Fed themselves is projecting a 4.1 unemployment rate, which would be up about 70 basis points from the low. And whenever historically the unemployment rate has gone up by over 50 basis points, it tends to accelerate from there to a higher level. It goes into another gear. And it's very consistent historically. I think there's a contradiction between the dot plot of the unemployment rate going to 4.1 and history. So I think that the Fed's going to be wrong on the low end for the unemployment rate for 2024. And I think that once you get the market de-inverting the yield curve and you start to really get the bond rally cemented into the DNA of investor psychology, I think that's usually the peak in risk assets. That's why I say it's okay now for the Braveheart idea of hold, but you're going to have to pivot. DNA
what
rate
did this
for
guy
20
say?
rate going.
Look, this is what I'm talking about. See how he's trying to make the case for bonds, which is great. Maybe you go 30% bonds, but why would you get long bonds if growth is going to reaccelerate? He doesn't believe it does. So listen to what he says about equities again.
4.1 and history. So I think that the Fed's going to be wrong on the low end for the unemployment rate for 2024. And I think that once you get the market de-inverting the yield curve and you start to really get the bond rally cemented into the DNA of investor psychology, I think that's usually the peak in risk assets.
Okay, so he's saying the unemployment rate actually spikes much more. He's not counting the fact that there's a gig economy, right? You're not going to see unemployment spike. You're not going to see jobless claims spike to what he thinks it is, to what he's saying, because there's still a big economy under the hood. There's a lot of services that are still, most people spend on services. That's most of the economy. And, there's just a lot of money in the market. Listen, most of the revenue is coming from these big tech companies. And what do? Produce media. They produce media. And so media isn't necessarily on the payrolls, right? So he's betting that unemployment spikes, and he's trying to make that case so he can to get people to buy into his asset class, which is, bonds will rise, right? Rates are coming down, but that's bullish for equities. If rates come down, that's very bullish for equities, unless what? Unemployment goes up too much. Well, those people who are not signing unemployment are those people who are not, not filing for jobless claims, probably because they're working for YouTube, not working for, but yeah, you could say that they have some type of gig, right? Some type of freelance work that's probably in YouTube software, something with software where it's Uber, Lyft, whatever it is. So he's discounting that. This is where the disconnect is there's an underlying gig economy. There's a new market. There's a new economy. It didn't exist 10, 20 years ago, the way where these guys are making their models that didn't exist. So there's new data that doesn't exist. It's not showing up. And so I think they're wrong.
That's why I say it's okay now for the Braveheart idea of hold, but you're going to have to pivot. And I think you have to pivot in a very intense way in both stocks and bonds when we get into the next recession. Maybe I'm wrong and it doesn't happen next year, but I think the odds have gone up, not down. We saw GDP now was about 5% or so in the third quarter, and it's now running, substantially less than that, and we're talking about maybe 1% next year. And I just don't think that's the way the economy works. Just like inflation overshoots on the upside, it overshoots on the downside. I think that the economy is going to undershoot on the downside, and the unemployment rate's going to go up, and that is going to create a totally different response. We're going to have to have a lot of money printing, I think, to battle the coming recession. And that's why you might have to pivot across the board, because the inflation.
Okay, so he's actually making the case against himself. If there's going to be a lot of money printing, that goes into risk assets. If there's more money print, if there's more monetary stimulus, then you're debasing the currency, and that doesn't make bonds go up because you're diluting the bonds, right? You're diluting bonds don't go up, gold goes up, Bitcoin goes up, risk assets go up. So I think he's missing the boat here. We had that recession in March of 2023, the banking crisis. That should have been the real recession. So what did they do? They turned on the money printer, just like you said. That should have been the recession. We turned on the money printer, bonds collapsed. Right? I'm sorry. No, my bad. Wait, did bonds no, bonds did go up. Bonds did go up because of recession, but guess what? So did equities, right? So did Bitcoin go up. So they're both going to go up, but over time, as money printing turns on, that supports growth. So the bond case is the one that slows down. The bonds have the first leg and then they slow. Equities have a first and second and third leg because money printing boosts asset prices, not freaking bond prices.
Inflationary consequences of that could be very substantial. So this is a long view type of thing, but for now, I think the Fed's pivot needs to be digested by the markets, and obviously a lot of that digestion happened today, and we'll see how the rest of the week plays out, because that pretty much takes us till the end of the year.
I want to sort of get your overall assessment of this Fed, because I remember so many of the conversations that we've had through this calendar year. Ones where you've suggested that, Powell was Mr. Magoo, going to drive into a wall. Other times suggesting he was up on this ladder and it's time to paint or get off the ladder.
Yeah, that was at the beginning. Yeah.
And here he is with this, what I felt today was a bit of a confident air about him in the way that he described this battle that they've waged over the last 12 months, and feels like they're in a pretty good space. How would you assess that?
Well, I think he does feel that way, and it may be transitory. He might just be in that Goldilocks sweet spot of that. But the Mr. Magoo thing was about how the Fed historically just keeps raising and raising until something falls apart. And he hasn't done that. As I said at the open, we've had 4 pauses in the last 5 meetings rather. That's a lot different than Mr. Magooing it and just bumping into dumpsters and stuff. He seems to have gotten in sync with the leads and lags a little bit better. I think he's learned something over the past 3 years, thankfully. And so we're at that point where he has repeated, as Steve Leisman said, he realizes that not all the tightening has gone through the system. So that's anything but hawking it up. I mean, that's him saying, some of the tightening is still yet to be felt. And that's going to be the case as long as we're higher for longer. As long as the Fed funds rate stays where it is, you're having problems in the system. You have a lot of loans. You've got banks that have investment portfolios yielding 3%, and the Fed funds rates at 5 3/8. So they're losing money on that. You've got small companies that are having elevated borrowing costs, and every single day it becomes more painful. And every month they have debt at lower interest rates that is rolling off. The fixed rate debt that was maybe issued a few years ago at 1%, that's rolling off, and that's higher. And so this is working its way through the system. He understands that. And so I compliment him on that. He's learned. And I think the only thing I can fault the Fed for in the past 5 meetings is that they shouldn't have hiked at all. They should have stayed on pause the whole time. But that's pretty close. And one more thing I want to say about economic indicators is the commodity price trend, which has been straight down in a nonstop way on a moving average basis for the better part of 2 years. And the Bloomberg Commodity Index.
Okay, and that is true. Commodities are falling. We got wheat down, we got oil down, nat gas got destroyed. You have copper's kind of even. Copper's not really falling, but the commodity index is falling, which is signaling he's going to say a recession. But he's going to try to make the case that's a big slowdown. But there's more massive stimulus coming from China and Japan. They're ramping up their manufacturing sector. So if anything, it's cheaper prices and growth can actually reaccelerate. He is not counting the fiscal policies. Again, I don't know why we keep, this was the same mistake that Morgan Stanley's Mike Wilson said is, well, I was wrong about fiscal policy. I didn't think it was going to be that supportive. Well, the Inflation Reduction Act $500 billion, the CHIPS Act, $350 billion, the infrastructure bill, $1 trillion. You add all those together and commodities are falling. Well, it's actually cheaper to build growth, right? It's actually, so he's missing the boat here. It's cheaper to actually grow growth, and it's cheaper to borrow money for growth. So yields are down, it's cheaper to borrow, and it's cheaper to buy the commodities to actually grow growth. So I think he's wrong here. I think he's looking backwards, and we'll see how bonds outperform. They'll probably run up with stocks, but come on, Qs and SPY and individual stocks are going to run up much faster than TLT.
Just can't get above its 200-day moving average and stay there. In fact, the gap is getting wider. And so it's interesting that, gold's up today, not surprisingly, with interest rates down, but commodities broadly on the BCOM are unchanged. So the stubborn weakness in the Bloomberg Commodity Index is further suggested to me that inflation is going to be lower than people think. And I'm wondering if we won't have a zero year-over-year inflation at some point in 2024.
I understand why you make the bullish case you do for bonds, which have, as you said, had a historic rally. November was the best month for Treasuries since the 80s, for obvious reasons. We've dropped near 100 basis points on the 10-year, for example. But why shouldn't people buy stocks today? Why shouldn't they say?
If you want to buy, because they're up massively since the last Fed meeting, and they're in pretty rarefied territory. And the economy is going to be slowing, and earnings are going to be less robust than people think. But if you want to own stocks, and of course everybody owns some, I think that one trend that has been very clear throughout 2023, for good reasons, is that equal weighted stocks like lower interest rates, and they don't like higher interest rates. The Magnificent Seven don't care, really. They're in a world of their own. But we've had a lot of talk about equal weighted versus market cap weighted. And we've seen equal weighted do quite well since the last Fed meeting. And there's a reason for that. The Fed hikes hurt the equal weighted more than the market cap weighted, because it's the smaller companies that get taken out by higher interest rates. And so I think you want equal weighted rather than market cap weighted at this juncture. And so I don't think there's a terrible valuation in the equal weighted market, but the market cap weighted market skips.
By the way, they've been saying that the Mag 7 or Apple, Microsoft, Amazon, Google, Meta, Tesla's arguable because it's very volatile, but Nvidia, whatever, they've been saying that their PEs are too high for the last 10 years, guys. We've been hearing this for they're overextended. The PEs are too high, and they still outperform because PE is relative to what's actually the use case in the actual economy. Yeah, if your price to earnings is too high, or basically your earnings are projected to be very high versus your price. I'm sorry, not as your price is going up versus your earnings. Well, that's because the future growth is much higher. That's because the actual expansion in the economy is coming from communication services. That's because the actual expansion, which is getting priced into Mag 7, is, electric vehicles. That's a new secular trend, right? That is going to change the economy. We're already seeing it, and there's arguments against it. You can't fight a secular trend. You can't fight an adoption cycle. Blockchain is going higher. AMD is going higher. Nvidia is going higher because there's a literal government, a global government mandate for chips manufacturing to build 5G, to build AI models, right? To compete with the global economy. So he's trying to say that, earnings per share or PEs are too high. Well, they've been saying that for 10 years. But the fact of the matter is the demand for the Mag 7 is also matching the price. There's a lot of demand, and they can earn in a recession, right? We saw growth slow coming into this year, and the Mag 7 still had earnings. Apple still grew their balance sheet. Right? Apple has a record amount of cash on the side. They can invest in anything that they want to. They can buy, they have more cash than most companies, the size of most companies on the side. So they're always going to say that, they're overextended, but we haven't even broke out to all-time highs. Go ahead and say that once the market breaks to all-time highs and then gets overextended. We're not even overextended on the weekly chart. When we get overextended on the weekly chart and the markets at our all-time highs, and we've kind of played out the growth, then maybe so. But if that's not the case, then you got to count in all the growth from fiscal, and you got to count in all the cash on the sideline that's leveraging back into these names.
Maybe 15 times in the equal weight, but it almost sounds like
it's a little too high.
Someone could take what you're saying, though, but someone could take what you're saying, Jeffrey, is making the case for an everything rally, that the equal weight part of the market, the S&P 473 for lack of or 493 for lack of a better description, obviously, is going to get a boost now if the Fed truly is done hiking and the next moves, multiple of which are cuts. The economy's still hanging in there. Why not?
Well, I just think that the everything rally concept is a realization of what's happened in the past 6 weeks. And we kind of expected that because we now have the full Fed pivot. It sounded pivot-ish, but it was more balanced back in November 1st. But now we have a full Fed pivot with the word any showing up and Powell talking about lags and all that stuff. So I just think that we're getting late in the cycle, and you can hang on there with risk assets. And I'm not exactly advocating against it, particularly in the higher credit sectors, but not investment grade, but the maybe double B sectors of parts of the bond market. But even there, I think.
All right, yeah, let's get off this. This guy's done. He's just making the case for bonds. Oh, you know what? Let's hear Josh Brown. I love Josh Brown. He's one of the best financial analysts or financial commentaries. If you haven't checked out his podcast, The Compound, go ahead and check it out. So Josh Brown, he's realistic. He's been calling for the bottom in stocks for a while because there's a huge demand for stocks. So I want to hear what Josh Brown says too. He's probably one of the top 5 commentators. He doesn't like Bitcoin as much, but he still owns it. And he's long Meta and long Netflix. Let's listen to Josh Brown.
Here on Closing Bell, let's bring in CNBC contributor Josh Brown of Ritholtz Wealth Management.
I'm crying.
I
have tears in my eyes.
What is your assessment here now? What does this mean for stocks moving forward? Let's just take it from there.
Some stocks are overvalued, but on the whole, the asset class, not overvalued. That's the only thing Jeff just spoke for 30 minutes. The only thing I disagree with him, the blanket statement that stocks are overvalued. You can buy small caps for 12 times forward earnings. You can buy mid caps for 13 or 14 times forward earnings. You can buy large cap basic materials 9 times earnings. I feel like there's a lot you could be doing away from the S&P 50, most of which are tech, consumer discretionary. There's a lot you could be doing where you are not overpaying for stocks, especially if you want to take the Fed at their word that we're going into a cutting cycle. I categorically disagree. Money markets were the trade of the year. $6 trillion in money markets right now. We don't need it all, quote unquote, all to go into stocks. If any meaningful portion of that $6 trillion goes into stocks, doesn't have to go into the SPY ETF. It can go into dividend aristocrats. Look at them. NOBL. Look at the way they're treating the VIG, Vanguard dividend. This is where the money is flowing right now because everybody understands this. You could buy stocks without buying the 7 stocks, and that's the trade right now. I think that trade carries us through. I have tears in my eyes. This is like the end of a romantic comedy. Everything fell into place. We're going out with a VIX at 12. What else do you want? We have vanquished. Who's laughing? Liz? I will see you in a minute. We have vanquished 9% inflation. We did it. We did it without a single person losing a job. Please understand that. We just printed plus 199,000 new jobs last month, and the war on inflation has been won. VIX at 12, stocks cheap enough to buy. All of the most widely held stocks in America having massive double digits, in some case triple digit rallies off the lows. Plus, we averted a potential banking crisis. What else could you have asked for out of 2023? I don't know.
You make the argument that the bear case is firmly dead.
No,
at this point.
No, the 2023 bear case is dead. The 2024 bear case is still ahead of us. There are probably going to be reasons to be concerned. But right now, as we end the year, you think about all of the things that went bump in the night, all of the things that we focused on day after day that could go wrong. None of them went wrong. They still could. They haven't. That's the story of, by the way, the story of 2023, a lot of conventional wisdom got turned on its ear once again. One of the big ones, I was talking with a housing market expert yesterday. You had Fed funds, essentially, you had mortgage rate go from 6% in February to over 8%. It actually started from 2.6% 2 years ago. What did home builders do this year?
All-time highs.
Up 50% on the year. That's not supposed to happen. A lot of things that weren't supposed to happen. And the big story, the Fed was not supposed to be able to, quote unquote, win the war on inflation without costing us any jobs and without throwing us into recession.
Because as the Fed chair, and I thought this was interesting too, and we didn't get to talk about it yet in the news conference, he was.
And here's what you're going to hear going forward. Well, the housing market is so weak, it's frozen. That's going to collapse. But there is a bid, all that demand that is not going into single family homes, all that demand is going into multifamily. There's a record construction spending for multifamily for those kind of construction bills. Look around. I mean, maybe you're not in a state or a city that's doing that, but there's a lot of demand there because it's away from interest rates. You know, it's not interest rate sensitive. It's not interest rate sensitive when it comes to demand for new home buyers, right? Or people who want to rent. And guess what? Rent prices are falling. Look on your Zillow map. Maybe not in your state. I'm in Phoenix, but look on Zillow. Rents are falling. Housing is falling. People have to drop it. And you say, oh, well, that's a financial crisis. No, because the Fed can cut before it even happens. Number one. Number two, it's not a financial crisis because most people that are locked in their homes are locked in at 3.5%, right? These are 15, 30-year mortgages. So they don't have to refi. It is just the new home buyers that are not getting anywhere to, they're not finding a home. Great. Well, guess what? All that goes into multifamily. So we're seeing a boom in multifamily there. And there's just a secular shift. We're just seeing a secular shift. And, what recession? Unemployment just fell. Nobody expected that. What recession? Why? Because the gig economy. People are not buying houses. They're either living with their family members, friends. They're getting smaller units, and they're still generating income. They still have jobs. So this is the case.
Discussing why, in his mind, the inflation that was caused in this cycle wasn't traditional. It wasn't caused by some out of control demand. It was caused in many respects by supply shocks. Sure, you can criticize the fact that they waited too long. They were buying mortgage bonds when mortgage rates were low. And you can criticize the government for piling on with a lot of the stimulus, but in many respects, maybe the reason why we're even having this conversation is because those things happened. And the reason why he can maybe declare victory at one of these next meetings is because better late than never. They were aggressive, they were quick, and now we're going to see what happens.
So Jeff was quoting from Braveheart. I'll do my own. William Wallace said, we all end up dead. It's just a question of how and why. Every bout with inflation ends up dead. It's just a question of how and why. The 1970s inflation paradigm was the wrong paradigm. I'm not the only person, obviously, that pointed this out, but I still think it's really an important lesson. The real paradigm to have focused on was post-World War II. We had tons of stimulus in the system. That's what was necessary for the arming of the country and the world against the Axis. That inflation took like 10 years to work itself out of the system. We had rising rates throughout the 1950s, and yet stocks were able to work, and we didn't really have any meaningful economic issue. That was the right paradigm. We had this massive burst of stimulus to make sure that society didn't tear itself apart, and we told people to stay home. It worked. We actually did too much of it, but it was not this lingering issue in the way that it was when we had oil embargoes and the like. It was man-made. We created it, and we were able to allow enough time to go by for that inflation to moderate. And it's not fully out of the system, and people are still paying high prices for shelter, for healthcare. Auto insurance sucks. I get it. I'm not saying like everything's great. Considering how much worse things could have been in this fight to bring inflation down from nominal 9% back on the road to 2, it could have been way worse, and it wasn't.
I mean, we're not, and that goes to, and we're not insensitive at all about the layoffs that have been announced. which layoffs continue to be announced in some respects.
On a
but
net
not
basis,
whole-scale,
on a net basis,
and
thankfully.
not to
Right.
the degree at which some suggested at this point, at least in the cycle, of both an economy slowing and a Fed.
And guess what? If layoffs happen, company margins go up, profit margins go up, and there's always another job to be had, right? There's always another job. This is not a freaking utopia where everybody's promised a job. You still got to go hustle for it. You still got to build your skills, and people are doing that. So people are coming into the economy, and guess what? If you don't get a job, well, the immigration is coming in and taking a lot of those jobs also. So I think that's the case. I'm going to finish off with the charts here just to kind of show you how strong this market is. I appreciate you guys staying for the stream. Thanks for, if you're not subscribed, subscribe, like the video if you guys want to help me. Oh, I probably went out for a second. So yeah, let's take a look here at what we got. All right. Strong S&P 500. Okay, we're done with that. The Fed set the market off here. Pretty good volume. Pretty good volume. So let's just go through these macro forces because the charts reflect what's actually happening. The charts reflect what's actually happening. All right. So this is SPX. This is SPX. We're almost back to all-time highs, right? This is the giant wedge pattern. So if you are familiar with wedge patterns, this is the big wedge pattern, right? As soon as we break this wedge, we don't even need to get to all-time highs yet, but we're going to get to all-time highs, and then we should be breaking out. Maybe we contract. I doubt it. There's a lot of volume coming in now with record money market fund cash on the sideline. That cash is on the sideline because the cash was afraid that inflation would come back. That cash was afraid that we'd head into recession. So there's a reason why that cash is on the sideline. Well, the recession doesn't look like it's happening. 3.7 unemployment, jobs still positive, fiscal policy still coming in, election year with more promising stimulus. Okay, productivity starting to pick up, more production, right? More unit of labor, lower labor costs, wages outpacing inflation, CPI. And that's why you have the S&P now breaking back out. So we're almost at that previous high. Now the Dow Industrial Average, which I think is going to be driven by a lot of the fiscal, is at all-time highs. So Dow now just hit all-time high. We haven't seen this, right, since January 2022. So it's been 2 years. Congratulations. We have just crossed. We just exited the bear market. The Dow just exited the bear market. And with good volume. Is it oversold yet? I mean, I'm sorry, is it overbought yet? Not even, we're not there yet. We still got some more time. This is where you really get elevated and it just kind of hangs around overbought territory for a while. You can see back in secular bull markets, right? You can see back in secular bull markets like this, where we just grind higher. We can literally stay, that RSI can stay overbought for a while. It gets overbought. This is weekly. And it just kind of chugs along, and it slips a little bit, and then it chugs along, and it slips, and it chugs along. What period was this? This was the Trump tax cut. So this was more fiscal policy right here. This big run up was fiscal policy. This was the breakout to all-time highs. Let's mark that up. Okay, this was the Dow breakout all-time highs. And we went pretty much vertical. Okay, we went vertical, got above, and this is where I think we're at in the cycle. I think we're right about here. We're getting to overbought territory as we break the all-time high for the Dow. And I'm not saying we go this fast, but there's still a lot of fiscal stimulus. We probably stay elevated. And then we had this big run up into January of 18. That was all fiscal, the Fed cut rates. And we're actually going to ease financial conditions. So that's very positive. So the Dow all-time highs. Okay. And the question is, do we have more room to run? And we turn to the dollar for that. We turn to the dollar. Well, does the dollar have more room to fall? The cost of global trade, right? Does it have more room to fall? Well, that was a triple top right there. That was a triple top, very strong resistance. It's getting shut down. So this liquidity is leaving the dollar and coming into markets. We still have a lot of room to come down here for the dollar. I thought we marked this up earlier. This is a different chart. So this is the rally right here. This is the rally. We probably bounce, have a little correction, and then continue lower or continue higher for risk assets. Point number two, where are rates headed? Rates are headed lower. We have a lot of room to fall for rates. Okay, this is not a stock. This is literally the bond market moving up while it moves down. As rates fall, that means bonds are being bid up. So as we head into the first 2 quarters of slowing, expect rates to fall because growth is slowing. Growth is slowing. And so that's going to pump the equity market. But once we get the all clear that, oh, we're not headed into a deep recession because productivity is picking up, because the manufacturing economy is picking up, because services are still positive, because there's more fiscal coming in, because it's an election cycle, and if anything does break, expect Biden to come in. Well, that will continue to fall there, right? VIX, this is signaling a new low. We're at the lowest levels on the VIX. So insurance against equities, people are now confident. They don't want to buy insurance. They're selling insurance. They're buying equities. Lowest level since January 2022, right? You need a black swan to really kick this off. So we're back into secular bull market territory for the VIX, looking at the VIX. Triple B spreads, right? There's a lot of confidence as this falls, or if I invert it, that's really confidence in corporates. 10-year, okay, yeah, we already went over that. And the Qs probably continue to lead this rally. Well, I guess you could say the Dow is leading the rally. You could say the Dow is leading the rally, but the Qs are near all-time highs. By end of year, we're probably going to be breaking out to all-time highs. And I think we continue that. IWM has some resistance up here, small caps, but now that there's 3 rate cuts being projected into next year. 3 rate cuts while growth is not falling apart yet, while growth is still positive. That's the case. And the monster asset right now is Bitcoin. Giant rally in Bitcoin. It is starting to correct a little bit, and that correction could come down. I don't think it comes down to 32K. Maybe so. Maybe it does come down to 32K, but you have the Bitcoin ETF, right? You have the Bitcoin ETF coming in. So this is very bullish for Bitcoin and crypto at the same time. Ethereum had that nice support, got some support on Ethereum there, pulling back a little bit. There might be some correction, but really it's all about macro. It's all about macro. And I think the most important chart, as we said all year, is the chart of oil. Why? Because it's the biggest input to inflation. And what you're going to get here, and I'll end with this, is as long as oil remains where it's at, gasoline prices come down. What does that do? That props up the consumer, or it keeps the consumer from draining their bank. A lot of the consumer, it keeps their wallets, at least even, because you don't want this going up. So that's strong. And as the cost of energy falls, well, the input prices for companies in general, industrials, maybe not financials, but industrials, communication services, home builders, whatever it is, their costs go lower. That increases profit margins. Next, OPEC or Saudi Arabia is set to flood the market because they've been losing market share. Yes, they've been cutting. I know they've been cutting to get prices up. So this big cut that they did where they were cutting production, well, guess what? Other areas, Iran, US, they're increasing production. So even though prices went up, well, they lost market share. They lost a lot of market share. So they're done losing market share. It's more likely they increase production. They flood the oil market in order to gain back market share. Because if your prices go up, but your demand or your full demand is lower, your full volume is lower. If you're receiving less volume, but your prices went up, you don't really make any money. So they need to increase the volumes or their reach. They need to increase market share before they start cutting again. They have to produce more. So they're probably going to flush the market. That's going to actually push the Fed more towards cutting rates even sooner. This could happen all in Q1. This could all happen in Q1. And there will be, recession. This is a sign of recession. You're going to see it. But more than anything, the bottom-up growth is picking up, right? Gig economy is picking up. So this is the most important, I think, still the most important macro, then the dollar and rates. So keep that in mind. Anyways, thanks for joining. I appreciate you guys sticking on there. Stay blessed, eat healthy, lift weights, get strong, learn something new, teach somebody what you learned, and I'll catch you guys next time. Stay blessed. Thank you.